Well, good morning, colleagues. I see it's past, and we're very grateful that you can join us for today's webinar. We do trust that you'll enjoy your time with us and that we'll have some good discussions around ESG in the context of capital allocation and the role of communication. My name's Adrian Bertrand. I'm a team member of Six Capital's advisory, and we're delighted to be bringing you today's webinar in partnership with Aprio Investor Relations. We're excited about our esteemed panel. So we have Nikki Katrakilis-Wagner, who's the Chief Executive Officer of Aprio Investor Relations. And we have Corley LaRue, an associate of Six Capital's advisory, and Melanie Smith, who's our practice head for research and reporting as a member of Six Capitals. And they will be our speakers today. We're also very much looking forward to hearing from each of you in terms of any questions that you might have and any comments. So we do ask that if you would like to contribute to the discussion, either by making a comment or asking a question, that you do so through the Q&A function, which you'll find on the left-hand tab on your screen, just below the attendees tab, I think. So just open up the Q&A tab and feel free to ask your questions or make your comments. The Six Capitals team and the Aprio team will be keeping an eye on those questions and comments during the course of the webinar. And we also have a panel discussion section for today's webinar where we'll do our best to address those questions. Also, just to mention that we will be running a few polling questions during the course of the webinar as the various presenters are speaking. And so we encourage you to participate in those polling questions as they come up. Just a little bit of information about Aprio Investor Relations and Nikki Katrakilis-Wagner, who's the CEO and participating in this joint Six Capitals Aprio webinar. Aprio Investor Relations is a specialist investor relations advisory firm. They're a member of the Aprio group of companies, and they also provide reputation and issues management, as well as strategic and digital communication expertise alongside their investor relations offering. Aprio's investor relations service offerings include the development and execution of investor relations programs, statutory reporting, stakeholder engagement, perception audits, as well as board and executive counsel. And we know that there are a number of Aprio investor relations clients joining us for this webinar, and a very warm welcome to you. Nikki joined Aprio Investor Relations as their CEO in 2019. She's held various executive roles across several sectors and has been ranked among the top 3 investor relations professionals in Europe, Middle East, and Africa, and is also a founding member of the Investor Relations Society of South Africa, with significant experience in finance. The Six Capitals team and I are very excited to partner with Aprio for this webinar. Corley LaRue, who's no stranger to many of you, is well respected in the area of ESG and sustainability, given her former roles as head of sustainability at the Johannesburg Stock Exchange. Corley is currently working on the CRISA Code Review project, which is keeping her busy. Melanie Smith has been a long-standing member of the Alternative Prosperity and more recently Six Capitals teams. She comes with a lot of passion and enthusiasm, having just finished a master's in sustainability, and she's heading up our research and reporting practice. Next slide, please. Just to mention a few of our own Six Capitals service offering. So we offer a number of services to both investors and corporates, as well as non-profits. We have an ESG and impact advisory offering, as well as a research and reporting advisory offering, which is the focus of today's webinar. Under our reporting advisory, we are keen to work with our clients and partners on materiality assessments around what's important for communicating with their stakeholders and investors. And I'm sure you'll find a lot of benefit from today's webinar and discussions. We also have an emerging development finance advisory practice where we are working with predominantly corporates around some of their enterprise and supplier development programs. And lastly, we have a financial education offering where we work as an implementing partner to both financial services firms as well as pension funds wanting to educate trustees and members of funds around financial education. And that can take the form of publications, as well as animated videos and face-to-face and virtual trustee training workshops and events. We're pleased to work with a number of well-respected clients, both locally here in South Africa, in Namibia, and also servicing some clients overseas. And we do look forward to engaging with each of you post this webinar, should there be any opportunities as a result of some of the conversations during the webinar. I'm going to hand over to Corley, who will now start the presentation around managing the trade-offs between short-termism and long-term value creation. Please do remember to ask your questions and make your comments in the Q&A chat. Thank you, Corley.
Thanks, Adrian, and good morning, everyone. I'm just going to switch my video on so that I can make virtual eye contact with you before we kick off. But then for bandwidth, we always find that it's easier not to always have the video on. But just a hearty good morning to everyone. It's really a privilege for us to be able to share this platform with Aprio Investor Relations this morning, and to talk to you a little bit about subjects that are really very, very critically important and growing in debate around ESG and capital allocation. So let me switch over to the PowerPoint. I mean, the first thing to note is really that we're intending to only scratch the surface of what is a very almost a controversial topic in a certain sense, and certainly a topic that many of you would be familiar with. So we also welcome your insights and experiences in dealing with this issue. To kick us off, though, I'm going to throw it back to you and to give us a sense for who we have in the audience and where you sit in the investment value chain. If I can ask our organizers to launch the first poll to give us a sense for where you sit in the investment value chain, to let us see who you are. Okay, I can see the votes coming in thick and fast. Quite a number from the investment community here this morning. Lovely to see a number of investor relations people as well, sustainability managers, other organizations. Okay, it looks like we have a really good spread here across the entire investment value chain, which is nice because that enables us to really have a good spread and a good conversation from different perspectives. It looks, let me share the results with you at this stage. Okay. Right. So having a good sense of where you sit in the investment value chain, let me just kick off with some basic information. So short-termism isn't a new topic, as I said. It's something that has been discussed and debated for a long time. But when you look at the Oxford Dictionary definition, I mean, it's pretty straightforward. It's concentration on projects or objectives that will yield immediate advantages or profit. But it's interesting to note that even the dictionary states that it's often at the expense of long-term security. And it is a system-wide issue. In the US context, we hear about quarterly capitalism, and many of the research topics that we looked at for this webinar gave us some nice other topics or kind of phrases such as it's the corporate Achilles heel, companies suffering from managerial myopia. So that gives you a sense for how deeply embedded this issue is. But why is this an issue? And what are the drivers that are causing it? So often in the research that has been done point mostly to the almost frantic trading patterns that we see in capital markets, demands for immediate profits, and the issue of transient, even institutional investors being transient. Again, we've seen the holding timelines for shareholding shrinking and becoming shorter. Even longer term investors are victims of this mindset. And what it often means is that this benchmarking and evaluation that are based often on 1, 2, or 3 month timeframes often means that companies are shortchanging their longest term strategy in favor of short-term profits rather than reinvesting corporate capital. And this clearly affects how they make capital allocation decisions. And when we talk about short-termism and capital allocation, I don't only talk about the issue with investors, but companies as well. So it sits across the investment value chain. Capital allocations are done with quick returns in mind. And how do you balance that then with value creation is the issue, and something that we'd like to just touch upon today. But particularly also today, we want to bring in the ESG context. Because sustainability issues are often associated with the longer term and longer term horizons, it's understandable that short-termism is seen as a significant barrier, and that often it is not perceived that companies can adopt a sustainable strategy that creates longer term value. But research is indicating that there's actually disagreement about whether or not taking a longer horizon view necessarily presumes the incorporation of ESG considerations. In other words, if you say you have a longer term strategy, it doesn't mean that you're necessarily incorporating ESG. The question is the counter also true, that if you take a short-term perspective, that you are not integrating ESG? I think the question or the perception is that you can integrate ESG regardless of what your perception is. What is the problem though? Why do we find that excessive market short-termism leads to inadequate incorporation of ESG issues? So again, the research here points to a number of things, and these are not new issues in the integration of ESG conversation. Clearly, market failures and the issue that markets don't drive the integration, lack of pressure from governments and regulators to force companies to internalize the social and environmental costs of their activities, the investment value chain that just keeps increasing in complexity, and the misaligned incentives across the entire value chain from asset managers straight through to company CEOs. Another key issue here is that there's an adequate understanding both by investors and corporates of the benefits of more sustainable investment and management. And coupled with that, despite the huge focus on reporting and disclosure over the last decade, there's still a sense that this is insufficient to demonstrate clear understanding of sustainability performance. So the short-termism issue then is clearly a reality. It's based on deep perceptions across companies and investors, but those perceptions lead to the fact that it becomes their reality. It is a topic of much study, debates, and campaigns. I mean, you just have to Google the topic to see the extent of research that has been done on this and the amount of activism to try and shift away from it. But interestingly, the empirical evidence that assesses the link between the causes and the consequences remains limited. Yet people are acting upon it. This graphic that you see on the screen here is from research that was done by McKinsey & Company between 2015 and 2016, where they surveyed over 1,000 C-level executives and board members from across the world, covering a full range of industries and functions. And overall, what they found in the survey is that firstly, short-termism is showing no signs of abating. And secondly, while the causes, as set out in this graphic, are manifold and spread out, it means that it's very hard for individual companies and executives to combat it alone. You need action across the entire value chain in order to combat the issue, because the pressures seem to grow. And this means that companies are struggling to codify their long-term plans and really articulate critical elements. And those long-term cultures that we're trying to cultivate within organizations are not clearly linked to financial performance in perception. So based on what I'm saying, let me test your own perception. Do you think it is always a problem? Or do you think there are perhaps ways of working around it? Can we launch that second poll? Okay, interesting to see the split there in views. Don't know if you can see it, but what I'm seeing is a split between the perceptions in terms of yeses and nos. Okay. So there we can see that there's a slight majority that feels it is always a problem, but I also see strong support there for it not always being a problem, and some are not entirely sure. Which is interesting. If I move on then to, as I mentioned in the beginning, we said that the problem sits across the entire value chain. And research that was done by the UNEP inquiry clearly demonstrates a link between short-termism within corporates and investors. And they found that firms that have a large number of transient investors are more likely to manage earnings to meet analyst and investor expectations. So when they focus on the short term, they tend to have a more short-term oriented investor base. And when they have short-term investors, that tends to reinforce a short-term focus within the firm. So it's a little bit of a self-reinforcing cycle, if you will. The research, interestingly, also found that companies that take a longer-term view may be able to attract a different type of investor, even a longer-term investor. Melanie will mention some of that in the recommendations when she discusses those. But what the research is then showing us is that there is that link between how corporates and investors think and the ability to influence what kind of investor you attract. And the question then comes, what are the implications for how you make capital allocation decisions and how you allocate your capital also for incorporating ESG considerations? So again, a question to you, and because we have quite a split across the entire value chain, if you are not able to answer this question within the context of your own organization, perhaps you can comment on what you believe currently the primary drivers of capital allocation are. So are we looking at, okay, no, the previous poll, not this one. So the one about primary drivers of capital allocation.
Sorry, Corley, it looks like because it's been loaded and then closed again, I don't think we're going to be able to do this poll. Apologies for that.
Okay, so the question was just trying to find out what people's thoughts are on what are the primary drivers of capital allocation. So is it risk management that primarily drives it, operational efficiency, research and development or innovation, or just strategy execution, or other reasons? These are the typical drivers for capital allocation. And maybe you can think about or inquire within your organization what your experience is in terms of how capital allocation decisions are made and what are the primary drivers. Are we able to launch the next poll, Adrian, about incorporating ESG?
Yes, I'm going to load that now.
Thank you. So that is the follow-up question then to, once you know what the primary drivers are, the question is, do you see ESG considerations featuring in capital allocation decisions? Or do
Sorry,
you
Corley,
not?
it looks like that one is also not able to poll. So we can start with, would you say the responsibility of managing short-termism sits with investors or companies?
Okay, no, that's only with Melanie, but that's fine. Thank you, Adrian. Again, I think the question that we were trying to investigate here is whether ESG considerations are featuring in capital allocation decisions. So even though the drivers may still be risk management, research and development, or operational efficiencies, are ESG elements starting to feature as part of these drivers within the capital allocation decisions that are made within your organization? And to what extent are we influencing capital allocation decisions through integration of ESG into strategy? So that's homework for you to go back and think about. The question then, I mean, now that we've established that short-termism is a real consideration, a real issue, even though it may not be always a problem, the question is whether there is an ideal ESG investment case. It is a question that gets bandied around quite a lot in terms of whether ESG can be integrated given the pervasive short-termism that sits within the market. So while the link, the causation between ESG integration and holistic financial performance isn't directly established as yet, evidence is growing, and clearly other benefits that can be gleaned from ESG integration are pervasive. And what we are seeing is, I mean, many companies can attest to the fact that they see less risk, less cost, and just operational efficiencies within their businesses. The interesting thing to note here is that it's not the adoption of ESG practices as a whole that translates into financial performance. However, what you do see is that it's quite context specific. So in certain industry, adoption of certain ESG elements will have a positive effect. And this also stands to reason if you consider the broad spectrum of ESG issues, that certain issues will be more material in certain contexts than in others. But one thing to also remember is that markets do not measure or reward your ability to create value for society at large, unless that value translates back into the organizational bottom line. But markets do reflect expectations of future earnings. So to the extent that the adoption of ESG can enhance those expectations by reducing or avoiding your risks or improving the efficiencies, then you could look at better market performance and being reflected in improved financial returns. A recent local study that was published in the Journal of Economic Financial Sciences just last year looked at 68 firms from across 6 JSE sectors over a period of 7 years. And they found a significant negative relationship between ESG disclosure scores and the weighted average cost of capital in 2 particular sectors. And what this means is that local firms that had improved ESG disclosure seemed to benefit from a lower overall cost of debt and cost of capital. However, it was interesting that equity capital providers seem to perceive increased risk from this disclosure, and therefore they require a higher return. But it does also highlight the opportunity that a growing number of capital providers consider ESG practices and disclosures as an opportunity to raise additional sources of capital. And capital suppliers are willing to accept lower returns and lending rates when providing capital to firms with superior ESG practices and disclosure. So that makes the link then between disclosure and performance, because investors rely on not only investor relations, which is what Nikki will be discussing in more detail, but also in the link to disclosure. But what then is the answer? How do we then balance the issue of managing short-term results with longer-term expectations? And the answer really lies in a topic which is now well familiar in South Africa, and that is the concept of integrated thinking. Because just as you trade off short-term and longer-term, you need to be making trade-off decisions across the multiple capitals within which you operate. Because the realization that you're not only managing financial capital, but a range of capital inputs and outcomes means that you're making, whether you want to or not, making trade-off decisions on a daily basis. And you need to employ integrated thinking to inform the various trade-off decisions, because companies that fail to balance the short-term expectations with longer-term results will often overlook the importance of developing strategies to address their material risks. And to make those trade-off decisions, then you need to be able to understand all of the various issues, including the ESG-related aspects of your operations and governance. For example, if you leave your global climate change consideration without thinking about it as a material, environmental, and financial risk, this is often absent from your engagements and annual disclosures, which means it is not discussed and it's essentially ignored, and investors are not able to make their decisions based on the full understanding of what the context of your company entails. So the integrated thinking and the trade-offs, they need to inform capital allocation decisions, but it also needs to inform your disclosure. And this is where I'm going to hand over to Melanie, who's going to talk to us about the role of communication and how to balance that with your integrated thinking and trade-offs. Thank you, Melanie. Over to you.
Good morning, everyone. We're glad to have you here. Corley, thank you very much for unpacking a complex topic on which much has been written in recent years. I think your last slide segues nicely into how one can use the role of communication to communicate how organizations approach that trade-off and to find that balance. So clearly, communication isn't only restricted to reporting. There needs to be transparency about the different trade-offs organizations make throughout the organization's stakeholder management strategies. And there is a need to improve the quality of engagement between boards, management, and investors as an antidote to the imperfections of the reporting system. We've seen a lot of movement in that space over the last few months, trying to move towards a more global framework of reporting that is trying to salvage or address some of those imperfections. And this not only then places part of the onus on investors, but also considers how transparent and effective leaders can be at communicating a more holistic corporate narrative. As such, companies should strive for improved quality of engagements and opening up a dialogue rather than just a one-way communication. And reporting then also needs to provide investors with a more holistic view of those trade-offs that occur. Adrian, we can then go over into our next polling question, which is on: would you say the responsibility of managing short-termism sits with investors or companies, or even both? I think there's often great debate around this topic and where the responsibility sits on managing this issue. Okay, we're seeing the responses come in quite quickly, and I think it's very clear from what we're seeing that our audience is also of the view that the responsibility with managing short-termism sits with both investors as well as companies. It's around 80% of the views on this platform for today. I'll show the results. Okay. We can then move over into speaking about some recommendations. I'll start with corporates. I think these few slides, I just want to kind of emphasize that these are UNPRI-based recommendations for corporate and investors. So it's some of it is not entirely applicable, or there might be one or 2 points that's kind of focused on the US based context. But I think there might be attendees here that sit in organizations that operate globally, which could be useful. And it's obviously a non-exhaustive list of recommendations to just mitigate some of the most serious consequences of short-termism through changes in strategy and practice, which links well to how important the role of communication is. I'd also, before I get into these, like to afterwards, or just mention that we'd like to engage our participants and attendees on today's platform on if they've experienced successes in maybe other strategies or approaches that have worked well or might have not worked well. So let's start with coping strategies that enable corporates to address short-termism in the existing investor base. It's important for corporates to have a good idea of the diverse interests and needs of the current investor base and target investors. This will enable them to do a thorough analysis on how investors, how short-termism has affected their business, capital investments, as well as financing of the business. Companies are also encouraged to define the outcomes they wish to achieve from their efforts to alleviate the effects of investor short-termism on their business, and they should use these outcomes to develop measures of successes and monitor the effectiveness of their efforts, and then communicate any of the short-term benefits that their sustainability-related strategies have had, and clearly articulate that as to the positive effects this has had on their net present value. Looking at some of the changing strategies that support a wider systemic change in the capital markets, these would include 2 recommendations that look to publicizing evidence of how market short-termism has affected their business, strategy, capital investment decisions, and their approach to sustainability and ability to create long-term business value. Corporates are also encouraged to engage with policymakers to address the negative consequences of short-termism and to adopt measures that will enable companies to take a long-term approach to sustainability-related activities and investments. Lastly, in terms of shifting to a more long-term investor base with corporates, it is advisable that corporates demonstrate how their business strategy, including their approach to sustainability, will create long-term value for the investors. And the next point is something that's been talked about quite a number of years now. It recommends that companies link senior management and exco performance to long-term performance of the business across a range of metrics that include relevant ESG indicators. And then the following recommendation is one of the points I mentioned about ending, that might be applicable to a more global audience. that companies should consider ending the practice of issuing quarterly earning guidances, which obviously then has a more prominent focus on the short term, and instead focus on communicating issues and metrics that are relevant to long-term successes of the business. But I think that's probably something one can keep in mind as a South African business as well, to rather use communication channels to focus on communicating the long-term successes of the business. And then some follow-up recommendations include directors producing formal statements that outline their duties as stewards of the company, and commit to long-term decision that state how they commit to long-term decision making, and explain how they define the long term, and how this relates to their business and investment cycles. It is also advisable for corporates to meet with current as well as potential investors to discuss their approach to creating and protecting value. These discussions should cover issues from sustainability, long-term strategy, governance, culture, risk and reputation, performance, and so forth. Going over into some recommendations for investors, which also considers coping, changing, and shifting strategies. And starting off with some coping strategies that will help companies cope with market short-termism, includes crafting and publishing their investment strategy, and publishing and explaining how drivers of long-term performance, including ESG factors, are taken into account in their investment processes. And investors should also encourage companies to articulate their business strategies and capital expenditure plans, and how these will create long-term value. And then additionally, in terms of changing strategies for investors that will support wider systemic market change in the capital markets, include supporting efforts to create evidence that demonstrates how a focus on long-term value creation delivers financial benefits, as well as supporting public policy efforts that incentivizes and rewards companies to take proactive actions to build long-term successful and sustainable businesses. Then just lastly, to end off and looking at shifting strategies, which will support long-term decision-making. These include investment strategies and commitments to long-term responsible investments, and ensuring that that's covered and effectively implemented in investors' investment policies, as well as encouraging companies to align remuneration to long-term value creation, and ending quarterly earning guidances and publish a board-level commitment to long-term decision-making, and also meeting with companies to discuss their approaches to creating and protecting value. Adrian, we are okay to go on to the next slide. So, like I've mentioned, the last recommendations I spoke to just now are some recommendations made by the UNPRI, but I do think COVID has really upset the apple cart and has drastically altered the business landscape. In fact, I think in many instances, the pandemic has resulted in companies now focusing more than ever on the short term as opposed to the long term. And I think it's then very easy to lose sight of that long-term vision. But some of the ways one can respond and think about in terms of situations that one finds oneself in at the moment, which is a bit of a crisis situation for some companies, is trying to be agile, to build resilience. and to not lose focus of the long term, and then be purposeful about capital allocation. Business leaders need to return to seeing short-term actions as a necessary servant to their company's long-term objectives. And yeah, I think there's sometimes actions that are needed to be taken in the present very quickly, but one needs to make those decisions and keep in mind the long-term view. We can move on to our closing slides from Six Capital's point of view. This is just a quote by the ICGN, which was published last year, and it just emphasizes the importance of corporate governance. Capital allocation often flies below the radar as a governance issue or a topic for investor, shareholder, and bondholder engagement. Yet capital allocation is highly relevant, even critical for the success of and sustainable value creation by companies. It is where corporate finance meets corporate governance and is one of the key outputs of the governance process affecting investors, providing risk capital, both equity as well as debt. It should therefore be a central corporate governance consideration for companies as well as investors. I will then give over to Nikki, who will go into more detail on investor relations and the importance of communication, and also present on some findings of a capital allocation survey Aprio ran just at the end of last year. Thank you very much.
Nikki, if you can just activate your microphone.
Morning, everybody. I'm in the process of sharing my screen and making the presentation available, and we'll kick off from there. Just a minute. Yeah.
While Nikki does that, just a reminder to please use the Q&A function in the webinar tab on the left. We'd love to have your questions coming through as audience members and comments, and the speakers will try and address those after Nikki's presentation. Thanks, Nikki.
Are you managing there, Nikki?
Yes, I am.
There we go.
So thank you, everybody, for joining us today. I'm delighted to also share the platform with Six Capitals. I'm sure you'll all agree that they provided some insight in terms of how companies need to manage capital allocation going forward, and some of the pieces of advice were well heeded, even from seasoned investor relations professionals such as myself. So similar to Corley and Melanie, I'm just going to shut down my video and then take you through the presentation as I've got it. 1 second, please. So just before I begin, as Adrian said, I'm Nikki Catrakillis-Wagner from Aprio Investor Relations, and I'll be talking about ESG in the context of capital allocation, what emerged from a capital allocation survey conducted on behalf of one of our clients, and then why communication matters. So let's start at the very beginning. I know it seems like ESG has been catapulted to the fore, especially over the last year, where there were amid adverse societal impacts of COVID-19. But ESG has been around a lot longer. It was first coined in 2005 amid a landmark study entitled "Who Cares Wins?" And it builds on the socially responsible investment movement that's been around even longer. The difference between SRI and ESG is that SRI is based on ethical and moral criteria and has a negative screen. So investors will not apply capital into companies, for example, that are in tobacco or alcohol or firearms. ESG, on the other hand, and especially ESG investing, assumes that ESG factors have financial relevance, which begs the question why, more often than not, ESG is often referred to as non-financial indicators, with companies having a corporate strategy and an ESG strategy. In the next couple of slides, I'll attempt to contextualize why this happens and why it shouldn't. So this is what corporates see. In terms of ESG funds outperforming, this has been well publicized with several studies showing this phenomenon. Companies with robust ESG targets often have richer valuations, are less volatile, and there are fewer instances of corruption, bribery, and fraud. Naturally, this allows fund managers to meet their fiduciary rights while incorporating ESG into their portfolios. ESG has also gained traction as a result of demographic shift, particularly around millennials who wish to align the companies they support with their personal values. They favor investments that are dedicated to solving social and environmental problems. More importantly, millennials can invest between $15 and $20 trillion over the next 20 to 30 years, doubling the size of the current US equity market. There's also more public interest in environmental and social issues. The rise and influence of social media results in more public interest and outrage to environmental catastrophes, and also a more vocal platform on corporates being non-responsive or an inertia around topical issues. There's also increased commitment and support. Signatories to UN Principles for Responsible Investment have grown to more than 3,000. This equates to over $100 trillion in assets under management. The Business Roundtable, signed by 181 CEOs, commit to leading their companies for the benefit of all stakeholders and not just shareholders. Global assets under management that apply to ESG data have doubled over the last 4 years. October 2020 marked the highest ESG flows on record at $36 billion. These were up 45% from September 2020. And the numbers don't lie. Returns are very real, as can be seen from this slide. On the left, iShares Clean Energy ETF performed exceptionally better than the Dow Jones Industrial Index, a clear outperformance. And closer to home, FTSE for Good Developed 100 was a clear outperformer. These metrics are only over a year. If we look back over 5 or even a more prolonged period, the returns from ESG funds would be a lot more compelling. So, despite the rise of ESG investing, there is a number of frameworks, there is still no consistent set of standards, despite a number of frameworks that have emerged assisting corporates in reporting on ESG issues. To name a few, we have the UN Sustainable Development Goals, we have the European Taxonomy Regulation and World Economic Forum set of metrics. We have Sustainalytics, which derives an ESG risk rating, which shows how much a company's economic value is at risk from ESG factors, and the most popular MSCI ESG ratings. Overlay this with more direct outreach. Larry Fink, the CEO of BlackRock. BlackRock is the largest passive fund manager in the world. His open letters to CEOs elevate the importance of ESG, albeit centered around climate change. Despite this, there is still no consistent set of standards that allow investors to make like-for-like comparisons and benchmarking. I concede, especially Corley and Melanie also referred to it, that there is movement on this front with an effort to produce a consistent universal framework. From the animation on the slide, fingers crossed. Which brings me to the first poll question. Do you think frameworks are a help or a hindrance? Okay. Well, that's an interesting outcome. Most people consider it to be a help. And that brings me to the next section of my presentation, because a lot of corporates look at this pool of ESG funds that are available. So in terms of the facts and figures that I've articulated in my opening slides, the pool of ESG funds is just too large to ignore. So despite the lack of standards, corporates do turn to reporting in an attempt to participate in this lucrative pool of investment dollars, with separate sustainability reports being commonplace. However, if we look at this graph, one could argue that reporting is a veiled attempt and not foolproof in securing ESG investment dollars. The graph compares the market caps of tech-savvy new age companies who are seemingly low impact with regards to ESG compared to legacy industries who are seemingly high impact but have significantly enhanced disclosures with regards to ESG metrics and are often considered as the gold standard in terms of reporting. What one can also conclude is that the cost of operating for legacy industries has increased. Capital has been diverted to those companies that seem to have a more efficient capital allocation model. Apple's market cap is almost twice the size of the top 20 mining companies, while Tesla, who by the way uses steel to manufacture cars, although not bigger, is fast approaching the cumulative size of the top 10 oil companies in the world. This is further amplified if we take a closer look at the typical ESG fund constituents. They're generally low-impact clean businesses that are involved in software technology, green automotive, semiconductor, and energy businesses. But their inclusion in an ESG fund reflects their disclosure. So that means they have adequately disclosed information or met a framework. So what this means is that the ESG fund inclusion measures their disclosure, not their activity. To this end, some of the good work that is being done isn't adequately valued. Mining companies, for example, have a bad rap because of their adverse impact to the environment. This often overshadows the long-term positive impact they have on communities around their operations. What is also lost in this approach is that many of these clean businesses use materials produced by legacy industries. According to the UK's Critical Minerals Association, a single wind turbine requires well over 3,000 tons of steel. To produce steel, we require metallurgical coal. Unfortunately, what frameworks do is that they encourage compliance or box ticking rather than commitment. So the next couple of slides will further underscore why ESG should be considered in the context of capital allocation. and why reporting on ESG may not be enough. In the first example company produces a 42-page sustainability report. The report is developed against the GRI standards. They've applied advanced level reporting criteria of the UN Global Compact, meeting 21 advanced criteria. They've been independently assessed, and not only do they form part of the MSCI South Africa ESG Index, they're considered a leader in the index. However, the graphic on the left of the slide shows their capital allocation strategy. In terms of how they deployed capital, shareholders were left wanting and the balance sheet left weak. Bearing in mind that share prices of future cash flows PV'd, a more conservative capital allocation model would have resulted in future cash flows being more richly valued. To avoid the criticism that I've only taken a sample of one, the second example company has an equally stellar track record in terms of ESG disclosure. In the period under review, it retained its inclusion in the FTSE for Good Index series and the FTSE JST Responsible Investment Index. It was included in the Emerging Index series with an ESG rating of 4.5 out of 5. It's been included in the Dow Jones World Sustainability Index for 9 consecutive years and is one of only 3 South African companies to be included in the index. Again, the graphic on the left articulates their capital allocation strategy. The same company sought to unlock long-term value or create long-term value through an M&A strategy. This capital allocation strategy failed them, and that's what's reflected in their share price. Which brings me to the second poll question, and we missed it in Corley and Melanie's presentation. Do you think ESG is considered in the context of capital allocation? So that's an interesting outcome. It was vacillating between 60 and 50%, saying that capital allocation is indeed considered in the context of, ESG is indeed considered in the context of capital allocation, which dovetails nicely with regards to a capital allocation survey we conducted on behalf of one of our clients. So the company had emerged from a period of high gearing and suppressed sector dynamics. The business is highly cyclical, capital intensive, with long lead times that may take years to deliver returns. So given that the company was emerging out of a high gearing period and becoming more cash generative, the allocation of capital was top of mind for the board and management. What we found in engaging with shareholders as well as non-shareholders of the company is that they expect management teams to be responsible in how they deploy capital and to a certain extent conservative. There was resounding support for ESG factors becoming increasingly relevant in the context of capital allocation. However, there was also an increased expectation with regards to return on this investment. This became acutely apparent when we were quite direct with our questioning. Are you prepared to accept a lower return if the company's efforts make the world a better place? And although respondents were quite diplomatic, their answer was unequivocal. No, lower returns would have to be compensated by better performance through increased efficiencies, further underscoring that ESG must and should be considered in the context of capital allocation. An ancillary outcome of the survey was that investors consider management's primary objective to be the allocation of capital. They didn't view it in isolation or separate to ESG factors. They expected it to be viewed as a worthy beneficiary in line with traditional uses of cash, such as M&A, capital investment, as well as dividends. Which now brings me to a concluding slide and some tips on how we counsel our clients in terms of communicating with investors and incorporating ESG into their strategies and into their communication. It was a further ancillary outcome as to the survey we did on behalf of the client, that although they deemed capital allocation important, they also deemed communication equally important. They felt that it goes a long way in building trust, giving confidence, and receiving support. So in terms of the tips and how you should approach ESG and communication, in the first instance, ESG cannot live as an acronym forever. It needs to move into the mainstream. Corporates need to determine how ESG investment can underpin and support commercial strategies, and also how this investment can create a competitive advantage in the long term. So if we look at the two example companies that I brought to the fore in my earlier slides, perhaps if those companies weighed up M&A or CapEx against investing in, for example, a solar plant, this would have created a moat around their operations, depending on what field they were in, and a clear competitive advantage into the future. The planet, their shareholders, all their stakeholders, and the company would have been better off. Quantify the value. Unilever does this very well. They say that they will grow by driving purpose-led brands and innovation. Over the years, they've been able to quantify the benefits of this strategy by articulating cost avoidance as well as total shareholder return. Hard numbers build credibility. Take a view of the future. For a long time, especially many sustainability reports are steeped and anchored in safety and health metrics and gender diversification. Our sister company, however, Aprio Digital, shared some insights on the impact of COVID on the digital landscape. The pandemic has changed the way we work, learn, communicate, and shop. So how does a changing culture and the role of technology give your company a competitive advantage? The final tip is, for me, probably the most important, and that's closing the loop. Corley and Melanie spoke about moving from a monologue to a dialogue, and it leads to reasonable and informed expectations. It also allows management teams to manage investors' expectations. Often clients will come to us and say, we're attending a roadshow or an investor conference, and we need a presentation that tells investors about our company. But what I've often found is that the most valuable outcomes of these engagements is not what corporates tell investors, but what investors tell corporates. So it results in a mutual understanding between the users of capital and the providers of capital, allowing both of them to focus on a common goal, which is the long term. So that brings me to the end of my presentation. I would like to take a minute just to talk about Aprio Investor Relations and what we do. We're a specialist investor relations advisory and a member of the Aprio group of companies. Our service offerings, as Adrian articulated at the start of the presentation, range from investor relations strategy development and execution, statutory collateral, which talks to earnings announcements and results presentation, stakeholder engagement using modern and impactful formats, and then in line with my closing slide in terms of ESG and in the context of capital allocation, closing the loop, which includes counseling the board and management teams, perception audits, as well as packaging the feedback that we receive from the market into actionable plans for our clients. And at this point, I would also like to extend my gratitude to my colleague, Troy Brady, who did most of the research and helped me compile the presentation. Before we move to Q&A, one last poll question. Does your corporate strategy integrate ESG? And we're happy to help you if it doesn't or if you require enhancement. Thank you very much. And with that, I'll hand over to Adrian.
Thank you very much, Nikki, and thank you, Melanie and Corley, for your respective presentations. So we've got that poll on at the moment. Does your corporate strategy integrate ESG currently? 70% say yes, 30% say no. So there is a little bit of work still to be done, but it is very good to hear that for those participants having joined the webinar, you are indeed starting to integrate ESG into your corporate strategy. So thanks very much, Nikki and Corley and Melanie, for your respective presentations. We're now going to move into the Q&A discussion. So if I can ask you to put on your cameras so that we can see you for the Q&A section. We did request questions from the audience. Those questions haven't really been forthcoming, so we've got a few of our own that we'll start with once we've got you on the line. So if you can just unmute yourselves, or you can keep yourselves on mute if you like, but just the video camera feed, please. And perhaps the first question, I'll be kind, and it's an opportunity if there's something that you would like to just make as a concluding remark in terms of today's discussion, you're welcome to say that, and every presenter will have an opportunity to provide that. But the first question for everyone is, if you were one of the participants on this webinar and they're either wearing an investor or a corporate hat, what is the one thing or the one takeaway that they should leave today with? And maybe that's an action item for them in the year ahead. So it's an opportunity for you to provide closing remarks, but also to opine on what is the one thing that either an investor or a corporate should consider as a takeaway in terms of today's webinar. Should we start with you, Corley, and then Melanie, and then Nikki?
Thanks, Adrian. I was afraid you were going to start with me. That's not an easy question. I think the important takeaway from me in looking back at the message that Melanie and I tried to bring across in our presentation is, balance is at the best of times a very difficult thing to achieve, whether it's in your own life or in running the business. But I think it's important that we pay more attention to how we balance decisions with various things. This is not to say that leaders and corporate leaders and investment decision makers don't do this, but I think particularly in the context of ESG, the number of things that you need to balance is becoming broader and broader. That also adds to the challenge, but I think it's there's a measured way of doing it. And I think in terms of advice, my suggestion would be is to start small and to develop a number of kind of well-defined metrics and measures to help guide you, and this can expand over time as one gets more mature. And I know that many of the people on the call are more mature in their dealing and integration of ESG. But I think a lot of it does unfortunately still happen in silos, and so to focus on integrating it at leadership level in terms of working with metrics and also evaluating that on a regular basis, and to go back and if resources allow, to perhaps go back and do a longer term assessment or diligence of how capital allocations have been made and to what extent ESG issues have increasingly played a role in that, will also give you a perception for how the organization looks at it, and maybe help you identify means of improving that. So that's my 2 cents worth in response to that question. Thanks.
Thank you, Corley. For you, Melanie, what would your key takeaway message be for an investor or a corporate who may be who would have joined today's webinar?
Adrian, so I think I'll link to Corley's comment around balance, but I think in terms of communication, and particularly around reporting, for investors and corporates to aim towards reporting a more holistic picture. I think oftentimes reports are seen as opportunities to only kind of paint the nice pictures of what organizations do, but there is a trade-off. And certainly those need to be spoken about as well. So creating a clear and holistic picture for investors around that balance.
Thanks, Melanie. Yeah, incredibly important to be balanced in the way that you report, both on what's been achieved, targets that have been met, and also where there's room for improvement or when those targets may not have been met. Nikki, your thoughts around key takeaways?
So in the first instance, with regards to corporates, I think when we especially go into a new client and we review their collateral so far, and then we say to them, well, what is discerning about you? Because what corporates often miss is that they are competing for capital. So when an investor is looking at the universe of stocks that he can potentially invest in, why does your company stand out relative to the rest? So, corporates tend to focus on facts and figures, especially CFOs, with all respect to any CFO that's on the call. But, it needs to be considered when you are presenting your investment proposition that you are indeed competing for capital. And to Melanie and Corley's point is that you need to manage those expectations in terms of the short-term dynamics in your sector or in your company and the long-term opportunities that you are facing. So that would be my advice to corporates, is when you're putting your collateral together and engaging with the market, consider the fact that you are competing for capital, and how do you differentiate yourself in the sea of listed entities. My advice to investors is that engagement with corporates, you usually have a 45-minute slot with a shareholder or an investor. The amount of time that is allocated to gross margin should equal the amount of time that is allocated to ESG. We need to move along now. I do find that still the engagement with investors is very much steeped in those financial numbers, and that's why corporates then look to their financials in order to articulate a story, rather than looking at it from a competitive advantage or creating a moat around their story. So, it's dual-pronged, and I think the poll showed that the participants thought that it's on both sides. But, if we're moving from a dialogue to a monologue, the avenues of communication and dialogue need to be set up by both parties that are in the conversation. Adrian, I know there are some questions on the chat, so maybe we can look at those.
Yes, thank you to those two participants who've posed the questions. So the first question from Irene Irene, it appears that short-termism buys companies time to focus on long-term ESG. What, in your view, is the catalyst for the change over time? And have you seen any evidence of this happening yet? So I'm going to read both questions. If you can start thinking about that, and perhaps one or two of you can volunteer to provide a response to Irene's question. So just, have we seen any changes already in terms of the transition to focusing more on the long term from an ESG perspective? The second question from Suzette Vivier is, and she firstly thanks everyone for their excellent presentations. The question is, do you regard impact investing as distinct from ESG investing? So is there a difference between impact investing and ESG investing? So do we have any volunteers around who would like to first address Irene's question?
It's a difficult question, Adrian, if I can jump in. And unfortunately, I just haven't done the research. There may be local examples. I think many people may be familiar with the international examples of companies such as Unilever, who have explicitly stated they focus more on the longer term. I mean, the one thing to say is that I'm not sure that we will ever be able to move away from the short term, and it's not, I think, perhaps something that we should be doing away with completely. It's about the balance of the short term and the longer term, and the understanding of what are the short term issues and what are the longer term opportunities, as Nikki was also saying. I think the catalyst for the changeover is where the trick lies, and I think what we need to get to is a more proactive approach as opposed to a reactive approach. I don't think that we can wait. In some instances, it may be too late. Some actors may feel that we've already reached the tipping point on many aspects, such as climate change, for example. And we don't want to be in a situation where we have a perfect storm of catalyst or catalyzing factors that cause that tipping point. We need to be more proactive in terms of identifying the issues. So that's perhaps not a fully satisfactory answer, but that's my bit that I can throw in. I don't know if anyone else wants to contribute to that, or whether you'd like me to touch on Suzette's question.
Nikki, do you want to add any comment to Corley's comments?
I don't think that we've seen a meaningful shift, but I think in the instance of many corporates, there is the view that they are able to manage expectations. So being a bit more forthright about the risks and opportunities that their company faces, allows them the time to invest in today for a better future. It sounds a bit cliched, but that's what companies need to do. And if they don't, they will quickly lose their relevance. And I mean, there are thousands of examples such as Kodak and Nokia who didn't invest today for the future and really don't exist anymore, at least not in their current form. But also what is important to underscore is that winning in the short term, it creates momentum and it gives management teams confidence. And it gives them credibility to make some of those big bets that they need to, and to then go out and say, we've built a track record of delivery over the short term, and that's why we're making a bigger bet over the long term. So to Corley's point, it's a fine balancing act, and I'm not sure that everybody has gotten it right just yet.
Thanks, Nikki. I certainly think the COVID-19 pandemic has really focused the mind of both corporates and investors around, focusing on the long term as well as, the short term impacts of the pandemic. And it's as good a time as any to really relook at our various organizational strategies to be resilient in the face of events like the pandemic. Corley, I know you were offering to respond to Suzette's question around the difference between ESG investing and impact investing. Bongi has also asked a question in the chat function just for a little bit of an update in terms of the revision of the CRISA code. And Corley, that's a project you're running with. So if while you're responding to Suzette, if you could also speak to just maybe a very brief update in terms of the CRISA code review process, and maybe some key thoughts around that. And then Melanie, I thought if we can ask you to start thinking about a question, and that is this move towards the kind of standardization of frameworks. So the IFRS Foundation is starting to put out consultation papers around how IFRS wants to now increasingly address sustainability and ESG. We see there's collaboration between the likes of the IIRC and the SASB standard setters. So just some thoughts, maybe firstly from Melanie and then other panelists around this drive towards one universal set or framework of principles around sustainability. Is that even possible? And what should people on this call be looking towards in that regard? Thank you, Corley.
Thanks, Adrian, and thanks for the question, Suzette. I will not endeavour to give you the proper academic answer. I think you far better placed than me to do that. But my perspective on it is, responsible investment and ESG investing, impact investing. These are all, it's part of a large universe of investment approaches. I do think though. And I think ESG investing per se is perhaps a catch-all topic or catch-all term that is used in various contexts. But impact investing is a very distinct approach where one, as an investor, targets specifically an impact outcome, whether environmental or social. So that has a very particular focus. My experience in relation to ESG is that it's often more targeted at integration of ESG from an operational perspective. So, for example, if you look at the way that FTSE uses, they make the distinction between ESG from an operational perspective. So, what are the risks and opportunities from an ESG perspective that a company faces, as opposed to their own contribution, so the impact that they have, which could be regarded as green economy, so the example that often gets thrown around is, a company that manufactures photovoltaic panels may be seen as a good investment from a green perspective, as they contribute to a positive environmental impact. However, in the manufacturing process, there may be many ESG type of risks that they may be exposed to in terms of managing the environmental impact of the production process, the social impacts in terms of the labor issues, human rights, and so forth, and the governance of the organization. So I think from an investor perspective, if you want to be looking at ESG, there are various ways of looking at it, and one needs to look at your own outcome or your own intended application of capital and what it is that you're looking for. I think in the context of this morning's conversation, we were probably talking a little bit more about normal corporations and how they operate and how they integrate ESG aspects from an operational perspective into their businesses in terms of managing those environmental, social, and governance risks and opportunities, rather than your pure impact investing, which is perhaps targeted on projects that have a positive environmental or social impact. So that's my view on that. I'm very happy to hear any other thoughts. Quick update on CRISA. Thank you for the question. It's a very, very interesting and exciting process, and the point that we are at now is equally exciting. So the draft revised code was out for public comment until the end of January, and we received just over 40 submissions, which are really robust in the engagement and the level of comment provided. So we're in the process of processing those comments. There was a working group meeting last week to discuss the gist of the comments and to make some recommendations to the main CRISA committee. And the main committee is meeting tomorrow to discuss the process moving forward. So we don't have absolute clarity yet, but there's likely to be a further process looking at how we deal with the various comments received, and that will inform what the process is moving forward. So we will communicate. We will make sure that the way forward is communicated as soon as we know what that's going to look like.
Thank you very much, Corley. So Melanie, I think if I can ask you to just talk about that globalization of, one single framework or standard, and you can start us off, and I'm sure Nikki may want to add some additional comment to that as well.
Thanks, Adrian, for the question. I think it's in the ESG space, at least, a hotly debated topic over the last few months. I think, at least in my mind, to be able to successfully assess sustainability risks, one needs to have a consistent and high quality data that's publicly available. and comparable to other corporates. So at least in my mind, the ideal would be to have a universal set of, or a universal framework under which corporates can report. The likes of BlackRock has encouraged organizations to make use of SASB and TCFD. I think given where we are at the moment with a drive to net zero economy, it makes sense to me to move towards the likes of a TCFD framework, just because it opens up the conversation around how your business strategy and governance and so forth deals with climate change and risk. So that's kind of just my 5 cents to the conversation. I'd like to also hear Nikki and Corley's thoughts on it. But I mean, I think it's a challenging thing, and you'll probably never be able to satisfy everyone. And I know there'll be a counterpoint to my point, in the sense that there's always special context that's needed for some companies in which they operate, which makes a universal set of reporting standards quite tricky.
Well, it's a work in progress and it's a daunting task. Nikki, have you had any of your clients asking for guidance on all of these developments and helping them make sense of it?
Must be honest, not yet. I think it's early days, and a lot of them are surveying the landscape in terms of the developments in that regard. But in terms of the question whether I think a universal consistent standard is required, I would guard against this so that it doesn't become a box ticking exercise. So people comply to a framework, and because they've complied, they don't really integrate their thinking around how they allocate capital, whether it's ESG or whether it's not. But I think what's important to underscore is that financial statements are reported on a standard. I mean, there's IFRS. But the standards allow some interpretation. So, companies apply a certain IFRS standard in line with their sector, with their business, with their current environment, and with specific circumstances. So some flexibility around a universal standard can go a long way in allowing users of that information to compare apples with apples.
Thank you, Nikki. Corley, I don't know if you want to come in there. I see we've got only 3 minutes remaining. Would you like to make a final comment?
Just, not in any length, Adrian, just to say that it is an emotive topic, but also, considering that there are a number of organizations that have been around for a long time. But I think the fact that the conversation doesn't go away means that we haven't really found the solution. And I think perhaps for the first time in the 20 years that I've been in this area of work, we're really seeing some big shifts happening over a short period of time. And the willingness of the various organizations to sit and work around a table and work together, and the fact that organizations such as IFRS and a broad investor community are involved, means that maybe we'll see something happening. I don't necessarily think a single global standard is something that's going to be achieved very easily, and GRI has been around for a long time and arguably has offered that standard for a long time. But I think part of the issue is to bring the investor conversation, or the investors into the conversation, to also start using the data produced from the frameworks, and to really have a marriage of minds between what those frameworks require and what information investors use, rather than having investors issue their own questionnaires and surveys to add to the burden of companies and what they need to report on.
Thank you, Corley. And thank you again to Nikki, Corley, and Melanie for their presentations today. It's been great to co-host this webinar with Aprio, and thank you, Nikki, and your team. Just an advert, if I may. Next week, Wednesday, Six Capitals and WWF South Africa are hosting a webinar on the TCFD framework. Six Capitals and WWF South Africa have been embarking on research in the last quarter, and we'll be sharing some of our research findings from that project. So please do join us. I've included a link to the registration for that webinar in the chat function. And we would also appreciate your feedback in terms of how you experienced today's webinar. So you'll see that there's a polling question. It is anonymous, but do let us know whether you found this webinar useful. And we will be making the recording from the webinar available to all participants. Do feel free to share that with your colleagues. And we'd love to hear from you if you've got any further questions or suggestions, or would like to either engage Aprio from an investor relations perspective, or Six Capitals from an ESG advisory perspective. With that, thank you again for joining us. Please do let us know how you found today's webinar, and we look forward to you hopefully joining us for next week's webinar with WWF. Alternatively, we look forward to you joining us at a subsequent webinar. Thanks very much and have a great day. All the best. Bye-bye.